Hello everyone, and welcome back to another episode of Simply Wall Street's Market Insights. My name's Michael, and this week we'll be talking about cashing in on chips, semiconductor stocks beyond the hype. Recently, most of the leading semiconductor stocks have traded lower. Notably, Micron Technology reported quarterly earnings per share and revenue ahead of consensus, and it reaffirmed its guidance, only then to have its share price fall by 10%. Some chip stocks seem to be priced for perfection, and that's where good just isn't good enough. So we thought it fitting to do a deeper dive into the semiconductor industry for two reasons. Firstly, because it seems everyone, including your neighbor's dog, is talking about it these days, yet they may not fully understand it. And secondly, the current market and economy are so tied to the industry that it pays to know where we might be in the cycle to avoid trouble and find opportunities. With Q2 earnings season starting soon, the biggest customers in the chip market, the likes of Microsoft, Alphabet, etc., will be reporting, and we will get an idea of how much they spent in the last 90 days. Then, the chip makers themselves will report, and we'll get an even better idea of the strength of the current spending boom. So, to get you prepared for those summer barbecue chats, for those of you in the Northern Hemisphere, we're going to break down the types of chips, the different types of companies, and the key players in this industry that spans the globe and powers just about every growing industry. We are starting this week with a brief overview of the industry and a look at the memory chip industry. So let's dive in. Before we do though, here's our quote of the week. If you'd asked me in 1980 what the big impact of microprocessors would be, I probably would have missed the PC. If you'd asked me in 1990 what was important, I probably would have missed the internet. Gordon Moore. Now, let's dive into what happened in markets this week. Here's a quick summary of what's been going on. McDonald's says McPlantBurger test failed. The New York Post. What's our take on this? The people have spoken and they want meat on their burgers. This is more of a problem for Beyond Meat than it is for McDonald's, since they were just running an experiment, while Beyond Meat is reliant on these kind of partnerships. Analysts are attributing Beyond Meat's huge share price decline over the last few years to soaring inflation and cratering demand for non-animal protein. Regardless, McDonald's is moving on from plant-based burgers and trying its luck with affordable $5 combo meals, and Beyond Meat will have to try its best to remain solvent, given its cash burn continues and its cash pile dwindles. Next, YouTube TV loses subscribers for the first time. Variety. What's our take on this news? If you offer a cable-like service, you may suffer a cable-like fate. YouTube TV, which offers major broadcast and popular cable networks, experienced in Q1 what most traditional linear networks have for years, a decline in subscribers. According to Variety, the ending of the NFL season in Q1, plus the lack of must-watch linear TV content, is taking its toll on both traditional TV and virtual pay TV. It may be a case like any streaming business where users jump in and out as they want for different reasons. But in this case, YouTube TV is $73 per month, whereas streaming platforms are in the $15 to $20 range, so value for money would be a huge factor here. Next up, Nike receives a slew of downgrades as it faces fierce competition. Yahoo Finance. What's our take on this news? Change is the only constant, and many big-name athleisure brands are facing their fair share of serious competitors these days. Nike and Adidas are seeing Asics, New Balance, On, and Hoka gain more traction in the sneaker space, while the likes of Lululemon are seeing Alo and Vori step up to the plate. While it's too early to tell, and some companies have tough comparable periods given the strong sales growth in the past few years, some of the big players are having their market share chipped away. It's important to remember that consumer preferences are constantly evolving and that brands, no matter how good they are, can't rest on their laurels. Next up, investors underwhelmed by Micron for not meeting lofty AI expectations. Reuters. What's our take on this? When expectations are high, so too are the downside risks. Despite beating estimates for Q3 revenue and providing Q4 guidance for revenue growth of 90% over the prior year, yes, 90%, this wasn't as much as the market was expecting. One analyst noted, anything less than fantastic is not good enough when your share price multiplies by 3 in just 18 months. However, while investors sold off the stock, analysts were still bullish and increased their price targets, as you can see on section 1.7 on Micron's company report. They saw the share price dip as a chance to add more to their positions because they like the company's long-term prospects. Next up, big tech uses reverse acqui-hires to avoid scrutiny. The Verge. What's our take on this? It's essentially a pseudo-acquisition, and this probably won't go unaddressed by the antitrust regulators forever. The likes of Microsoft and Amazon have been doing what's called reverse acqui-hires, where rather than acquiring a company outright and having to get approval from regulators to do so, they simply hire the vast majority of the staff at a target company and pay a hefty licensing deal to sell their models on their platform, because these are usually AI companies. The target company then becomes a shell of itself and uses the funds to return some capital to shareholders while Microsoft or Amazon retain their staff and the models. It sounds like an acquisition if you ask us, and the regulators might think so too, so big tech may not be able to pull this off forever. And lastly, the $6 billion gold scam, BBC. What's our take on this? BriX was a Canadian gold mining company that struck gold in 1995 when it announced the discovery of the world's largest gold reserve in Indonesia. The share price soared from just 20 cents to $286, giving the company a Canadian $6 billion valuation. That was until it emerged that the entire thing was a fraud, and there was no gold, none whatsoever. This podcast series we found is worth a listen if you'd like to know how a fraud can unfold and how easily investors, including more than one pension fund, were fooled by a good story. It's particularly relevant to anyone investing in speculative penny stocks. Now let's dive into the main piece, an introduction to the semiconductor industry. Here's a question for you. What do artificial intelligence, automation, the metaverse, fintech, the electrification of the economy, the Internet of Things, blockchains, health tech, EVs, cloud computing, mobile commerce, and cybersecurity all have in common? The answer? They cannot happen without tiny components made of silicon, aka microchips, and integrated circuits. Pretty much every major growth industry and secular trend, we left out a few, relies on microprocessors and other semiconductor components. This graphic from Quarter shows us just how many components go into an iPhone and who makes them. Beyond the excitement and hype surrounding AI chips, the semiconductor industry is massive and complex. For investors, it does take time to properly research and understand the companies, but there are 3 very good reasons to do so. Firstly, it's crucial to all those long-term secular trends. That means winning investments can compound for decades. Secondly, designing and manufacturing chips is very difficult. That allows the winners to develop very wide moats, as Nvidia, TSMC, and ASML have done. And finally, the industry is far more cyclical than other tech industries. This gives savvy investors a chance to invest at very reasonable valuations when the cycle is in a downtrend. So here's a quick primer on the industry. Before we look at the companies that make up the semiconductor industry, here's a quick overview of the types of chips they make and the broader industry, along with some of the jargon that's going to come up later. Silicon's conductive properties give it widespread applications, including the production of solar panels and display screens for mobile phones, computers, and televisions. But the term semiconductors is usually used to refer to microchips. A microchip is an integrated circuit, IC, consisting of 1. Transistors, which act as switches or amplifiers and control the flow of electrical current, 2. Resistors and capacitors, which regulate the current and voltage, and 3. The other components. These components are etched into silicon at a scale that now allows smartphone chips to contain tens of billions of transistors. Microchips are used to store and process data in various ways. If you're keen to know how they actually work, this video here does a pretty good job of explaining that in just 3 minutes. Chips are generally divided into 3 groups. Memory chips store data, e.g. the chips in a USB flash drive. Logic chips process data, e.g. CPUs and GPUs. And analog chips control power and convert analog signals like sound and temperature into digital data, e.g. the microphone in your phone. Some chips perform just one function, but components are usually combined or packaged for specific use cases and tasks. Some chips just perform one function, but components are usually combined or packaged for specific use cases and tasks. Here's a list of some examples. Microcontrollers perform specialized tasks that are used to control electronic devices. Microprocessors are more powerful and can perform a wide range of tasks. These include CPUs, central processing units, and they can perform a variety of tasks, but they only perform one task at a time. GPUs, graphical processing units, can perform a narrower range of tasks, but can perform more than one task at a time. CICs, or commodity integrated circuits, are lower cost chips that are used for specific or general purposes. FPGAs, known as field programmable gate arrays, can be modified by manufacturers after they're produced. FPGAs are widely used in the production of connected devices. ASICs, which stands for Application-Specific Integrated Chips, are designed to perform specific, repetitive tasks. The likes of these are used for Bitcoin mining. SoCs, or System on a Chip, combine various types of chips into one chip. These are commonly used to power mobile phones. And lastly, embedded devices are devices that perform a specific function within larger devices, like computer systems in cars, traffic lights, ATMs, point-of-sale systems, etc. Chips are manufactured in fabrication facilities known as fabs. Fabrication of chips is difficult and capital-intensive, which has resulted in many companies choosing to outsource production and focus on design and marketing. These companies are known as fabless chipmakers. Only a handful of companies still actually manufacture chips, with TSMC dominating this industry. The companies that still design and fabricate chips are known as integrated device manufacturers, IDMs, and include Intel, Samsung, and Micron. The design and manufacturing of chips is supported by a huge ecosystem of companies that provide the software used to design and test chips, incredibly expensive equipment used to produce and then package the finished product, and of course, all the raw materials used throughout the process. Now let's talk about memory chips. As the world produces, processes, and consumes data at an ever-increasing rate, PCs, mobile phones, and data centers need somewhere to store that growing mountain of data. Artificial intelligence models also rely on rapid access to that data, meaning memory chips might be one of the most overlooked part of the AI arms race. The memory chip market is fiercely competitive and is dominated by a small number of firms. Samsung, SK Hynix, and Micron Technology account for 96% of the DRAM market. The same three companies, along with Western Digital and Kioxia, account for 95% of the NAND market. Samsung leads in both markets, but memory is a fairly small part of the much bigger empire. Nevertheless, it has contributed to a big jump in earnings in the last year. NAND flash memory. Flash memory is non-volatile memory, meaning it can retain data without power. This is the memory that stores data and programs files on a PC or mobile phone. This is the type of memory found in USB flash drives and memory cards. Non-volatile memory is essential to any computing system, but has some limitations, including speed. DRAM memory, or dynamic random access memory, can only store memory when it's powered. However, it is faster than NAND memory, so it's better suited for processing data. HBM, high bandwidth memory, combines stacked DRAM chips with an interface to increase the speed and volume at which the data can be accessed. HBM is used with high-performance processors like GPUs and AI accelerators. This is a small but rapidly growing part of the memory chip market. The market for memory chips is the most cyclical in the industry. Memory chips are very much a commodity, and prices and volumes are a function of supply and demand. In addition, prices fall over time while volume increases over time. The cost of DRAM per gigabyte has fallen by about 26% each year since 1990. But the amount of data the world generates, stores, and processes is increasing at an even faster rate than that. Demand is also affected by replacement cycles for devices and new product releases at each stage of the supply chain. So, while prices fall and volumes rise over time, that doesn't happen in a straight line. The chart below illustrates just how cyclical Micron's revenue and earnings can be, and the fact that negative earnings and cash flow can be a reality sometimes. So, what's the insight here? Make sure you understand research and development and Capex cycles. Memory chips might be a commodity, but designing and manufacturing chips is very different from growing corn or wheat. No offense, of course, to the farmers out there. Chip makers have to spend vast amounts on research and development and capital expenditure to remain competitive. For fabless chip companies, most of the investment goes to R&D. Chip makers that design and manufacture chips need to invest in both. In 2023, Micron spent $3.1 billion, or 20% of revenue, on R&D and $7.7 billion, 49% of revenue, on capital expenditures. These investments have just as much impact on earnings and cash flow as they do sales. They are also necessary to ensure future profitability. The way research and development and Capex are accounted for is very different and usually goes a long way to explain the gap between earnings and free cash flow. Firstly, research and development is an expense and includes salaries and fees for services used to develop new products. R&D falls under operating expenses, which are subtracted from gross profit to arrive at the operating profit and net income or earnings. So, higher R&D spending leads to lower earnings in the same period. Whereas capital expenditure includes investment in equipment and other assets. These investments don't appear on the income statement immediately, so they don't affect earnings in the current period. But they do appear on the cash flow statement and result in lower free cash flow. These investments are also recorded as fixed assets on the balance sheet and then depreciated over several years, depending on the type of asset. Depreciation is recorded as a non-cash expense on the income statement. The bottom line here is that R&D spend immediately reduces earnings, while Capex is gradually deducted from earnings in the form of depreciation. Section 3.3 of each company report on the Simply Wall Street platform reconciles the difference between earnings and free cash flow. The graphic above reconciles SK Hynix's negative earnings with its positive free cash flow for the 12 months to March. In this case, the loss was mostly due to a large depreciation expense, which was offset by Capex and falls within the red bar labeled Other. Now let's wrap up with the key events during next week. There were a few mixed signals last week as job openings rose unexpectedly while business activity in the services sector fell sharply. US inflation data later in the week may provide some clarity. As for this week though, on Tuesday, in Australia, the Westpac Consumer Confidence and NAB Business Confidence Indexes will be published. Both indicators are forecast to fall slightly. Also, US Fed Chair Jerome Powell will testify before Congress. On Thursday, UK GDP data is due to be published. The economy is forecast to have grown 0.1% in May after stalling in April. Also, US CPI data will be released. The annual inflation rate is expected to be 3.1%, down from 3.3% in May. The core inflation rate is expected to fall from 3.4% to 3.2%. And on Friday, US PPI is forecast to show producer prices rising 0.2% in June after falling in May. Second quarter earnings season starts on Friday with the first of the big banks reporting, and this includes JP Morgan, Wells Fargo, Citigroup, BlackRock, and PepsiCo. That's all for this week's Market Insights. Thank you so much for listening. And until next week, invest well. Simply Wall Street analyst Richard Bowman and Simply Wall Street have no position in any of the companies mentioned. This recording is general in nature. We provide analysis based on historical data and analyst forecasts only, using an unbiased methodology, and our articles are not intended to be financial advice. It does not constitute a recommendation to buy or sell any stock, and does not take into account any of your objectives or your financial situation. We aim to bring you long-term, focused analysis driven by fundamental data. Note that our analysis may not factor in the latest price-sensitive company announcements or qualitative material.